Hello everyone. If you are considering Turkey as a base for international trading, a major tax change introduced in 2026 could be highly relevant to your business. Law No. 7582 amended the Turkish corporate income tax law and expanded a significant tax reduction for certain international trading and brokerage profits. Under the new rules, corporate taxpayers may benefit from a 95% reduction on qualifying net profits. For qualifying companies in the Istanbul Financial Center with the required participant certificate, and in certain eligible industrial zones, the reduction can reach 100%. But this is not a 95% exemption on sales revenue. It is a reduction applied to qualifying net profit. The incentive covers two main activities: purchasing goods from abroad and selling them abroad without bringing them into Turkey, and acting as an intermediary in purchases and sales taking place outside Turkey. Several conditions must be met. The goods must remain outside Turkey, or the transaction must qualify as international brokerage. The qualifying profit must be included in taxable income, transferred to Turkey within the required deadline, and properly reported on the corporate tax return. The transfer requirement is especially important. The law refers to transferring the profit, not the full sales proceeds. Companies should therefore reconcile purchase costs, sales revenue, direct expenses, net profit, transfer date, currency and Turkish lira equivalent. If the profit is not transferred on time, the missed reduction cannot normally be recovered by transferring it later. With a partial transfer, the reduction is generally limited to the portion transferred on time. Documentation is critical. Contracts, invoices, bank statements, SWIFT records, shipping documents, warehouse and customs records, and accounting documents should demonstrate the complete commercial flow. What if goods temporarily enter Turkey? Placing goods in a bonded customs warehouse does not automatically eliminate the incentive, provided they are not released into free circulation, used or substantially processed in Turkey, and are sent to the foreign buyer. However, if the goods enter free circulation or are sold to a Turkish buyer, the conditions may no longer be satisfied. Certain digital products, codes and intangible rights may also qualify under specific conditions. Complex licensing structures should be reviewed carefully. Here is a simple example. A company earns 10 million Turkish lira from qualifying international sales. After 8 million lira in purchase costs and direct expenses, its qualifying net profit is 2 million lira. With a 95% reduction, 1.9 million lira is deducted, leaving 100,000 lira subject to corporate tax. Assuming a 25% tax rate and no other adjustments, the tax would be 25,000 lira. This is only a simplified example. Other tax rules, losses, non-deductible expenses and transfer pricing adjustments may change the result. The incentive also interacts with Turkey's domestic minimum corporate tax system. Qualifying Article 10/1I profits can be deducted when determining the minimum tax base. However, this does not mean every transit trading company will pay zero tax. Other taxable profits and adjustments may still create a liability. The incentive applies to corporate taxpayers. Individuals, sole proprietorships and ordinary partnerships cannot directly benefit from Article 10/1I. VAT must also be considered separately. When goods are sold outside Turkey and the transaction does not take place in Turkey, Turkish VAT will generally not arise on the goods transaction. However, related services such as logistics, warehousing, consultancy or financing may create separate VAT obligations. Related party transactions must comply with transfer pricing rules. Prices and commissions should follow the arm's length principle and the commercial rationale should be properly documented. So, what is the key takeaway? Turkey's 2026 reform creates a potentially powerful tax advantage for companies conducting genuine international goods trading and brokerage activities. But simply calling a transaction, transit trade, is not enough. Contracts, invoices, ownership transfers, physical movement of goods, customs status, the location of the parties, net profit calculation, transfer of funds to Turkey and accounting records must all support the same commercial reality. For businesses considering Turkey as a base for international trading, this incentive could be valuable. Eligibility should always be assessed transaction by transaction under current legislation and the company's actual structure. This video provides general information and is not individual tax or legal advice. Professional advice should be obtained before applying the incentive. Thanks for watching. For more information, you can directly contact us.